Hello, welcome to SPJIMR Alumni webinar series. I'm Professor Ratika Gore. I'm currently also handling the alumni relations for the Institute. I'm an alumnus myself. So it's my pleasure to tell you that we've had an overwhelming response for the series. We've had registrations right from all over the world, from China, from US, from UK, Dubai, Singapore, and of course many cities in India. So today, the agenda is this, that Professor Ananth Narayan will be talking for around 35-40 minutes. And then there'll be another alumnus, Siddharth Parakh, who will take over moderating the Q&A round with him. Siddharth is a chartered accountant and an alumnus from PGDM, graduating year of 2017. He's an investment banker with MAPE advisory in M&A and private equity, and is himself an avid investor. And of course, now I'd like to invite my colleague and friend, Professor Ananth Narayan. Most of you, probably all of you already know him. He's a very strong voice in this space. And recently he was in news for being appointed as additional director by RBI in Yes Bank. And he's often seen in many media channels talking about this space. So Ananth, over to you.
Hey, thanks a lot, Ratika, for that very warm welcome. And morning, afternoon, evening, everybody, wherever you are, I hope you're all safe and sound in these very surreal times. I hope you're using the time to learn new skills, to brush up on all things and catch up with the family and so on and so forth. And I hope you're keeping safe. Lots of things which are going to change over the course of this COVID-19 situation, pandemic, along with the stuff which is already happening in terms of technology, etc. So I'm sure the way we conduct our lives, the way we conduct our businesses, everything will probably change. And I hope you're getting prepared for that. To start with, when COVID-19 is behind us, and I hope and pray that soon, do remember to go back to the old days. Remember that it's not enough to wear a shirt and a jacket. You also have to wear your trousers on, for instance, when you go outside. So a few pointers about what I'm going to speak about on Indian economy and a few caveats. To start with, I'm going to speak solely about the Indian economy. I'm not talking about the global economy. I'm not talking about Indian markets. I normally try and avoid giving predictions about markets, but sometimes they slip out. If they happen to slip out, and if I'm right, then remember me and remember SPJIMR. If I'm wrong, then this conversation never happened. I'm sorry about that. The other caveat, which has to be given, is economics as a field is changing. It's getting redefined every day. Just as the ways of doing business are changing, economics is changing. So what you'll hear today is only a point of view. It is not necessarily the right point of view. We will find out as we go along what the right point of view is, if there is one. In fact, there's this old joke about economists, which is that for every economist, there is an equal and opposite economist sitting somewhere, and somehow they're both wrong. So those are the two laws of economics. With those caveats, let's get on to the talk itself. Look, I'll try and break this talk up into three parts. I will start with the state of the Indian economy as we entered COVID-19. We'll then look at what COVID-19 could end up doing to our economy. And then finally, we'll look at how will the economy emerge after COVID-19 and what will be the policy options in front of us. How could the future look like once COVID-19 is behind us? And once again, I emphasize and pray that COVID-19 gets over really fast. Because I'm talking about the economy, I'm going to gloss over some of the very real humane and humanitarian issues which unfortunately we are going to confront, and we are confronting. This is a painful situation. There is hardship involved for lots of people. Unfortunately, when I talk in economic terms, I'm going to kind of skip through a lot of that, but that's the reality. That's the way it is. So the broad gist of what I'm going to say is the following. It's that our economy was already weak before we entered COVID-19. The Indian economy, unfortunately, will take a battering as we go through COVID-19. And I cannot overemphasize this. It will be a real battering. And we probably find ourselves at policy crossroads as we emerge from COVID-19. So that's the broad gist. Let's start with the first part. How was the Indian economy as it entered into the COVID-19 situation? You know, a lot of people tend to compare this COVID-19 situation with the global financial crisis of 2008. yes, there are some fair comparisons, and at multiple levels, it's not a fair comparison. One of the points of differences between 2008 and 2020 now, for India specifically, is that when we came into the global financial crisis, we were actually doing reasonably well. Our economy had been growing for the last 7-8 years. Our fiscal deficit, or the state of our government's financial balances, was actually looking better. It was improving, and therefore we had a lot of room to actually maneuver through the global financial crisis. Second thing about the global financial crisis, it did not impact us directly. That was about the subprime crisis. That was about monoline insurers in the US and elsewhere. India got impacted on the rebound, in a secondary fashion rather than a direct fashion. So both of that was actually advantages as far as India was concerned. Unfortunately, with COVID-19, the situation is very different. One is that the state of the economy is pretty weak to start with. And unfortunately for us, COVID-19 is also hitting us directly. It's a direct impact as opposed to an indirect impact. Now, in what way is the economy weak? I'll talk about 3 pillars of the economy which indicate the weakness, and then I'll talk about a 4th angle, which is what's the government's response so far. The first part of weakness is the state of our financial services ecosystem. That's largely our banks, our non-bank finance companies, our housing finance companies, our microfinance institutions, and then the paraphernalia of mutual funds, insurance companies, pension funds, etc. That's been extremely weak. Now, in what sense has it been weak? The banks and non-bank finance companies have been grappling with very, very large non-performing assets. Now, there is this lovely report called the Financial Stability Report, which the RBI comes out with every 6 months. The last one shows that as of September 2019, the actual or the professed non-performing assets across banks and non-bank finance companies was at 8.6% of advances. There's about 100 lakh crores of banking loans. There's about 40 lakh crores of housing finance and non-bank finance company loans. Of that 140 lakh crores, about 8.6% of advances was gross non-performing assets. For comparison's sake, India's GDP is about 200 lakh crores. So total loans are about 70% of advances. Of that, 8.6% was the official non-performing assets. So here is the bad news. The bad news is 8.6 by itself, which is a big number, is not the right number. The real number, the actual number, was far higher. Why was it far higher? That's because the level of disclosures, particularly for non-bank finance companies, and even within banks, as far as their loans to small and medium enterprises and certain real estate loans, which were not being accounted for properly, the level of disclosures were inadequate. If you were to correct for that, the true level of non-performing assets was closer to 12% of advances. By comparison, that number in 2008, by the way, was closer to 2 or 3%, so much, much, much lower. Now, 12% is a bad number. So one of the reasons why banks and non-bank finance companies were struggling to grow, struggling to lend out further, is they were already burdened by this huge amount of non-performing assets. So that was the first point. Now, if this engine is not in a position to lend money, frankly, growth becomes a big, big problem. The second related pillar, which is a big issue in relation to the overall soft economy and related to the first issue, was several sectors of the economy were chronically stressed. They were not viable. This includes sectors such as real estate, sectors such as power companies and power distribution, etc. Sectors such as telecom, sectors such as airline and shipping, automobiles, you can argue is cyclical, but nevertheless automobiles as well, and many, many small and medium enterprises. All of these key sectors were chronically stressed and they were simply not viable. In fact, a lot of the loans given to these sectors were the ones which were hanging on as non-performing assets on the books of banks and non-bank finance companies. And the sad part was, for many, many years, it's not just the last 5-6 years, but for many years, we've been kicking the can down the road on finding solutions to these chronic problems. I'll give you a glimpse of the nature of the problems. In the power companies, for instance, in India, we have these distribution companies, or discoms as we call them, which are run by the state governments, which actually have a leakage of about 20% of the power distributed. They're not able to get the billing collections done because of theft, because of leakages. As a result, these discoms end up borrowing money just to pay the power producers. And the accumulated debt over time has now crossed, I think, about 2.6 lakh crores. So it's climbing every year. These companies are actually borrowing money just to pay bills, which is not really viable at all. So that's just an example. So first part, banks, non-banks in not a good shape at all. Second part, several sectors of the economy are really in a weak shape. Third part, which is frankly far more insidious. Look, what has been the biggest benefit or the biggest resource that India claims to have? It's clearly our people, right? It's people like yourself. It's people like the SPJIMR family. Talented, aspirational, very, very good people capable of doing big things. That's been our strength as a country, right? Unfortunately, this demographic, which is supposed to deliver a dividend, has been struggling to be converted into jobs and output. And and this is again not a 4-5 year problem. This is a decadal problem. This is multi-decadal problem. Some of the metrics we look at in relation to this demographics makes for pretty sad reading. So here is a glimpse of that, right? By the way, there is this Azim Premji University report which actually delves into a lot of Labor Bureau statistics, which gives a lot of good information about the nature of India's demographics. It also refers to something called the Periodic Labor Force Survey, which actually the government of India came out with for the year 2017-18. Here are some of the statistics which come out of that. So India's worker participation rate, which is what percentage of our population actually is working, is now below 34% or almost close to 1/3 of the population. Just 3 decades back, that was closer to 45 to 50% of the population. So the number of people working is actually, in a funny way, shrinking as a percentage of the population. Second demographic factor, only 17% of our GDP, as measured by the CSO, is actually contributed by women. Unfortunately, our women participation rate has been coming down quite dramatically over the years, which is in a way inexplicable. In a way, it's really sad. And in a way, it sets us behind people like Bangladesh and Vietnam. The growth you're seeing there in some of their industries, including in ready-made garments, has been because of the women workforce. In our case, unfortunately, we are not tapping that huge part of the population which can be so productive. Third statistic which I can think of from the PLFS, the Periodic Labor Force Survey, that shows that for the year 2017-18, in the rural areas, as much as the unemployment amongst the youth was as high as 20%. Now, that's a crazy high number, and this is across men and women. And unemployment being defined as people who are looking for jobs and not getting jobs. That's a crazy high number. There are plenty other, depressing statistics. The broad gist of which is that, listen, we simply have not been creating jobs and output over the last few decades. Forget about the last few years. Why is that the case? Why is it that with all our capable people, with all our resources, with all our social structure, etc., why is it that we're not able to create jobs and our cost structure? It transpires that when it comes to ease of doing investments in this country, when it comes to land laws, when it comes to labor laws, when it comes to contract enforcement, when it comes to policy stability, when it comes to legal processes, India is not really an investment-friendly country. What that means is if you had to set up a company here, employ people, acquire land, employ 100 people, start producing, get capital in, it can be extremely tough to work it on the ground. Notwithstanding our spectacular improvement in the World Bank ease of doing business, on the ground ease of doing investments across land, labor, capital, and other laws, very, very tough. So it's been a pretty sad 3 pillars: weak financial institutions, many stressed sectors, critical sectors of the economy which are chronically stressed, and demographics, which is supposed to be our biggest strength, actually underperforming in terms of delivering jobs. So all of this put together was actually reflected in some pretty soft growth numbers coming over the last few years and last few quarters. It's been very, very disappointing. For the last fiscal year which went by, fiscal year 2020, ended on 31st March, the third quarter growth was just 4.5% of GDP. That's the real number. The nominal rate of growth was 6.1% of GDP. I haven't seen such a low number for many, I think 40, 50 years now, right? So what was the government's response given this obvious softness in the economy? Well, actually, the government was trying a lot to pump up the economy. One unfair criticism that's given to the government is You're being too pedantic about things like fiscal deficit. What is fiscal deficit? It's how much more does the government spend over its earnings. You're being too pedantic, you're putting a lid on your fiscal spending, and therefore you're not kickstarting the economy. You should be doing a lot more. Well, as it transpires, actually the government has been trying hard to kickstart the economy by pumping in a lot of money. And in fact, the fiscal deficit of the government, center and states all put together, is far higher than is acknowledged. The real number is actually hidden behind some accounting smoke screens. So very quickly, for fiscal year 19, which is ended last year, the official center plus state fiscal deficit was 5.9% of GDP. Now, as I said, there are accounting smoke screens involved here, which have been admitted by the finance secretary. The last finance secretary has come out with a large blog explaining how the smoke screens came about. Long story short, the true borrowing of the government between the center, the states, and the public sector enterprises, which is a better reflection of the true fiscal deficit of the country, was closer to 9.7% of GDP. That's an enormous number, by the way. And this is at a time when the actual savings rate, which is all Indians put together, how much are we saving into our financial savings, was less than 6.5% of GDP. Here is another shocking statistic. For the past 5 fiscal years, since FY16, on average, portfolio flows coming into the country every year across debt and equity markets has been less than $3 billion per year. So effectively, households aren't saving enough. We aren't getting enough of global savings. And the total of household and global savings through portfolio flows is far lower than what the government has been borrowing. The ultimate result, if you're borrowing far more than you're saving, is obviously interest rates would go up. Yet they didn't go up. Why didn't they go up? Because effectively, the RBI was monetizing the deficit by buying government bonds and transferring profits to the government. Effectively, shorn of all the jargon that you're hearing out here, we were printing and spending money. So essentially, the RBI was printing money for the government to spend money to try and give a fillip to the economy. And so the sprint and spend has been going on for 3 years. Remember, I told you that the GDP growth for the December quarter was only 4.5%. If the government had not spent what it spent, the actual GDP growth would have been just, in fact, below 3% of GDP, 3% growth. The actual increase in the government spending was over 12.5% for that quarter. So, summary, financial services ecosystem is weak to start with. Second, lots of your sectors, critical large sectors, power, real estate, airline and shipping, telecom, these and small and medium enterprises, these are chronically stressed. Third, very, very important, we aren't converting our demographics into a dividend. We aren't creating enough jobs, possibly because of lack of doing investments on the ground, right? And as a result of all this, we were already doing printing and spending. This is our pre-COVID economy. What is COVID-19 going to do to us? So I'm going to keep away from the medical part. I don't know enough about the medical part. The numbers are rising. Chances are that the real number of cases is far more than has come out publicly because we're not testing enough. But here's the good news, guys. When you speak to doctor friends, when you speak to the medical community, you aren't hearing of egregious number of cases piling up in the hospitals. You aren't hearing of community transmission to the extent that, let's say, in places like Dharavi or in the Jugis of Delhi, you have a lot of pain coming through. You don't hear of ICUs being chock-a-block. You don't hear of ventilators running out. So it feels like things are under control as of now, and I hope and pray and touch wood that it remains that way. We don't know how things are going to pan out. By the way, the only reference that we have is the Spanish flu of 100 years ago, 1918. That was a devastating flu for India specifically and for the globe as a whole. And by the way, that flu lasted for 3 years and it went in 3 specific spikes. It didn't end with one spike. Now, I'm hoping and praying we don't go down that path. Multiple things are in our favor since then. At that point of time, we didn't have antibiotics. Antibiotics was discovered 10 years later. So secondary infections hopefully will be kept under control. Second, the chances that we come out with a really fast vaccine now are much, much higher than they were, let's say, 100 years ago. Medical science has clearly improved globally. So I'm hoping that things remain where they are, they don't get worse. So all the numbers I'm giving you in terms of the economic impact is assuming we don't have an extended lockdown, which means on May 3rd, when the lockdown ends, we slowly limp back to normal. It's not by any means guaranteed we'll go that path, but I'm hoping and praying that this is the actual implication. The point is, even if it's just that, even if it's the lockdown till the 3rd of May with partial opening up since 20th of April, our economy is going to take a really strong hit on the back of already being a weak economy. So let me try and break up the impact of the COVID-19 into various levels. I'll start first with what is the likely GDP growth for the country in this year. And I'll tell you why that's a useless data to look at, but being a professor, I'm going to give you useless data anyway. Thereafter, we'll go into various impacts at various levels, at the workforce level, at the businesses level, at the financial services level, at the government level, and at the Reserve Bank level. First, what's the GDP likely to be? Here is the first caveat. Data coming out anywhere in the world at this point of time is frankly suspect. Do you know that, for instance, the CPI data which came out for March in India, only 66% of the data points required to form that final data of what the CPI inflation is was actually available. Why? Because there was lockdown already in place. And by the way, in March, only the last week was lost in lockdown. Despite that, a big chunk of data did not come through, right? Now, as we go along through the lockdown, getting in data is going to be really tricky. Getting in reliable data is going to be very, very tricky. And for people who research the economy, like Professor Tulsi, Professor Patnaik, myself, etc., not having data, not having proper data is going to be a real inhibition, a real problem. It's going to be a real inhibitor. But nevertheless, let's take a look at what the GDP growth could be. Now, you're hearing estimates coming out from various people that it could be 1% of growth only, it could be only 1.5%, 0.8%. By the way, for the rest of the globe, the predictions are even more dire, right? So -6% for the US, -5% for, actually -6% for Europe as well. For Japan, again, it's a big negative. Almost every country is supposed to see a contraction, except for China, where, by the way, the numbers you really can't rely on. India is supposed to show a small positive as well, as per most analysts, as far as they tell us right now. Personally, I'm unable to see how we register a positive growth this year. I think we will show a degrowth as well. Why is that the case? Look, through the lockdown, through until April 20th, at least when the whole country was under lockdown, at best, 36% of the economy was operating. What are these parts of the economy? Agriculture, food and beverages, healthcare, public administration, utilities like power, telecom, etc., other services. And here I'm being generous. For instance, we know power consumption has come down dramatically since industries aren't working. But even if I was to give benefit of doubt and say, okay, fine, let's assume they're all performing as normal, you still have 64% of the economy completely impacted, right? So for this 64%, if I assume that they're going to be impacted for 20 days, then a smaller impact for the next 13 days till or 14 days till May 3rd, thereafter, it will take time of 1 or 2 months to recover. If I take these very, very conservative estimates also, I get -1% growth. I don't get a positive growth at all. But here is the caveat I mentioned. Again, I'm going to repeat it. These numbers are useless. Frankly, a large negative growth is also not a problem. What matters is how do we recover from it? We know we're going to have a bad time for the time being. So let's look at the anecdotal evidence, which frankly research people don't like to look at, but we don't have a choice. Data is not available. Let's start with the workforce. So again, that Azim Premji University report that I mentioned, the Labor Bureau statistics, they tell us that in 2015, the total workforce in India was about 467 million, 46.7 crore was the workforce, of which only 17% was salaried. 37% was casual and contract labor, largely daily wages. 46% is self-employed. So 83% between self-employed, contract labor, and casual labor, which live pretty much on most of which live pretty much on a hand-to-mouth existence, they are going to be impacted in a big, big way. Even salaried people are going to be impacted. But these people who are pretty much on their own without a safety net, remember, we don't really have a social service, a social safety network available in India. These are going to be impacted very, very badly. So if 2/3 of your economy is already closed down and multiple parts of the economy are going to struggle to come back, can you imagine what's going to happen to people on the ground who are working? It's unimaginable. Frankly, people like us are probably living, and I hope and pray that's not true for all of us. People like me are definitely living in a cocoon. We're living in a nice, we have the luxury of staying in a house with a family, etc. What's happening on the ground in the real India is really brutal. There are people who are driving taxis, people who are workers who are in construction sites, people who are engaged in all kinds of services and in all kinds of shops, etc. They simply have no livelihoods at this point in time. It's a brutal, terrible time, right? So it is going to be extremely tough on this workforce, and the impact of that is going to be far worse than anything that we've seen. It's worse than demonetization, it's worse than GST, it's worse than anything that we've seen. On businesses, very, very similar story. In fact, echoing the first part. As I mentioned, we entered this COVID-19 already pretty weak. This is going to be a real body blow. I've spoken to, and I'm sure you've done the same, I've spoken to many people across many businesses. One auto ancillary person who reported that he has fixed costs. He's a large operator. He's got about fixed costs of about 30 crores per month, largely interest costs and salary costs. His top line has been zero since 15th of March. He's not selling a single part at the point in time. His point is, even after May 3rd, if let's say he opens a factory, and luckily for him, his workers stay close by, so he can get the workers in as well, assuming that there is no further lockdown. He says, listen, I don't know what's going to happen to my orders. I don't know when people will start buying 2-wheelers and 3-wheelers and 4-wheelers again. So even if I get the factory started, when will my sales start? I spoke to this very large ready-made garment exporter in the south as well, in Tirupur. All his export orders have got cancelled. His biggest customers were in Europe. They have cancelled every single order because they don't know what's going to happen next. He's got consignments which are stuck in the high seas, which are not getting delivered in any port. So again, his same point, even if the lockdown was to open on May 3rd, he has no visibility of when operations can start. I spoke to a small person who was in forging in Chennai. Again, the same problem. He had a very good Jan, he had a very good Feb, and now he's seeing absolutely no sales coming through at all. So long story short, across multiple businesses, across several services, across several manufacturing units, we are going to see pain, and it's going to be a big body blow. Let's come to financial services now. Again, a reflection of what we saw in people as well as in businesses. So I mentioned to you that already 12% of advances is stressed as things stand right now. In addition to those stress sectors, if I look at all those sectors now, where you have to be worried about if you are a banker having given out loans, there's a ton of sectors you have to add to that list. What kind of loans do you have to add in the watch list? Loans on commercial vehicles, loans on construction equipment, loans given to people in hospitality, in education, in multiple fields. Again, loans given to non-bank finance companies because they in turn have lent out to real estate and to commercial vehicles and to other automobiles and personal effects, etc. Retail has been considered as a safe haven spot for many years now because wholesale loans have been a bad word. The big loans given to infrastructure have been a bad word. Retail has been seen as being relatively, with low non-performing assets. Unfortunately, with all the distress we are seeing at the workforce level, particularly retail loans which are given unsecured, like personal loans, or retail loans which are given to self-employed people, including to small and medium enterprises, they're going to be a big problem. So all the sectors put together, which fresh come into the watch list for banks especially, is about 28% of advances. Now, even if out of that 28%, let's say 8% becomes a non-performing asset, that 12% that I told you of non-performing assets that banks started with, that goes up to 20% of advances. That's a killer of a number. It's the highest number, close to the highest number we've ever seen in India, and it will really weigh down the banking system as a whole. Now, what does all this mean? A stressed workforce, a stressed bunch of businesses, especially the small and medium enterprises, a stressed banking system. The government has no choice but to spend lots of money. Economics, you're taught, you shouldn't spend beyond your means. Unfortunately, that no longer applies. We will have to spend a lot of money as a government. So what are the areas they have to spend on? First is on the first responses, right? First responders. You've got to get PPE, you've got to get medical equipment, you've got to take care of your patients. The essential medical responses have to be taken care of. Second, if you have hunger, if you have people who are deprived of basic daily wages, there's no safety net. You have to ensure people get that. So you can't sit and think about, theoretical fundas of fiscal deficit, etc. You have to spend to ensure there's no starvation, that people get basic requirements. Third, you have to make sure that all the critical services are being delivered. Power, water, utilities, food, medicines, ventilators, all of that. You've got to keep that running. So again, you have to spend money on that. Fourth, you have to save small businesses. Otherwise, they're all going to collapse. You also got to save your bank. So all put together, there is a ton of spending the government will have to do. Remember, it's already been printing and spending. That will go up even further, right? The way I see it, remember I told you that the center plus state plus public sector enterprises put together was about 9.7% of GDP net fiscal borrowing, a good indicator of the fiscal deficit. That number could easily go up to 16% of GDP. Why is that? Two things. One, your tax collections and your receipts are going to come down. There is no economic activity happening right now. What taxes does the government collect? For state governments, the biggest revenue collection normally comes from liquor sales. Liquor sales have been stopped. So again, big revenues earner has simply gone away. Likewise, there's no earnings happening. There's no economic activity happening. So no GST, no indirect taxes, nothing. So between lower tax collections and lower receipts and higher expenses, which are going to be inevitable, I can see at least a 6% net extra impact, which means the borrowing by the government itself can go up to 16% of GDP. I told you that 9.7 itself was high. Now it goes to 16%. If 16% of GDP, is the actual borrowing by the government, at a time when you and I don't have money to save, or the people as a whole don't have money to save, and at a time when global funds are actually withdrawing money, in March, India lost $16 billion of foreign portfolio investors, 8 in debt, 8 in equity. Because there's a global risk of every emerging market saw a hammering, they saw money going back, right? So in these circumstances, if 16% of GDP borrowing goes through in the market, you will see interest rates shoot up through the roof. So once again, the RBI will have no choice but to print money to prevent interest rates from going up. If you allow interest rates to go up, that will be a killer for the financial institutions, that will be a killer for businesses as well. So you can't let interest rates go up, yet you have to spend, which means that the RBI will have to print money. Effectively, at least 3% the RBI will have to monetize, which means print money, maybe even more. So which means that printing and spending continues. So that's the overall state that the COVID-19 is going to leave us with. What is it going to be? Hardship at a worker level, hardship at businesses level, non-performing assets could go up to 20% of GDP. The actual fiscal borrowing of the government could go up to 16% of GDP. And the monetization, which means the printing by the RBI, could go up by another 3% of GDP. This is all assuming there are no further lockdowns. If there is another round of lockdowns, all bets are off. I hope and pray we don't have to go through another lockdown. I don't even want to do the analysis of how the economy will look like if we have to go through one more lockdown. So now that's the state at which we will emerge. So what happens after we emerge out of COVID-19? By the way, just a word on the sprint and spend. I'm crying about 6% extra fiscal deficit. And many of you would know, in the case of Japan, they have just declared a 20% of GDP stimulus. In the US, they've already declared about 12% of GDP stimulus. In fact, President Trump and the Congress are talking about even more. Germany has done 6% of GDP stimulus. Everybody's printing and spending. So what's the big deal if India prints and spends as well? After all, if everybody's doing that, there's a big difference. And now, by the way, I told you economics is being rewritten. So it's quite possible new theories will emerge. Keynesian economics came after the 1929 depression. So maybe new economics will get written now. But fundamentally, logic tells us that we can't compare ourselves with the US, Japan, and Germany for a couple of reasons. US is able to export its currency. There is a global, all of us on this chat like US dollars. So US can print money and it can export it out. Everybody wants it. We don't print a hard currency. We don't print a currency which everybody in the world wants to grab, right? There are people in Nepal or people in Mustafa in Singapore who take rupees, but otherwise there's not a broad acceptance. So there is that is the first problem. Second problem, look, it's okay to print money as long as you have domestic output, which
which matches up to the demand created by that printing of money. What does all this mean in simple terms? Look, you're stimulating demand by giving out money. So let's say everybody's given out some money. So we all go and start buying some stuff. When we buy stuff, if that goods that we are buying is being made inside the country, that's absolutely fine. No problem. In fact, it can become a virtuous cycle where there is demand which comes up that actually starts to get supplied. More jobs therefore come. More jobs means more money gets created, more demand, and it becomes a nice virtuous cycle. That's what China did, by the way. So do you know, for instance, I mentioned to you that India's loans across banks and non-banks was about 70% of our GDP, right? 140 trillion rupees. In the case of China, across banks and non-banks, loans given to the private sector is more than 2.5 times GDP. Okay, it's more, in percentage of GDP times, it's like more than 3 times the number given out in India in comparative percentages to GDP, right? How is it that they sustain that? By the way, giving out loans is also money creation, just as printing money is, right? Because every loan you give also creates a deposit, right? Now, how is it that they sustained it? They managed to sustain it because they also started producing goods. They gave out jobs, they created jobs, and they started producing goods. So which means that they could actually feed into a virtuous cycle of creating jobs and creating money. On top of it, they started producing goods for the whole world. They became the manufacturing capital of the whole world. So they actually had much more output coming out than the money they were creating, which is great for them. So similarly for us, the problem is, and the question is, for the money we are pushing in right now, will the demand be met locally or do we have to start importing it? By the way, one quick word, none of this demand is going to come immediately. For the next 6 months or until the lockdown effects wear out, we're not consuming anything. We're sitting at home consuming nothing, right? But eventually, when COVID-19 is hopefully behind us very fast, we will, all that money sloshing around will start to buy stuff, right? Unfortunately, all our past experiences of printing money, including after the global financial crisis, we started buying goods which were not produced in India. Or the amount of goods which were being produced was simply of a limited quantity. So the demand went into things like proteins, dals, eggs, pulses, milk. And suddenly the food inflation started shooting up because there wasn't enough supply to keep up with that. And therefore you had inflation going up. On the other side, the other goods which were being bought included things like electronics, included things like plastics, chemicals, fertilizers. All of these have large amount of import components. So again, our imports went up. So we were printing all this money, which were either chasing a limited amount of goods and creating domestic inflation, or chasing imported goods and therefore creating a currency weakness. So the old regime that too much of money printed can cause inflation and can cause currency weakness absolutely applies in our case. Along with the fact that the rest of the world will look at us and ask us if we start printing and spending because we are not a developed market. As a reference, last week, Indonesia was put on negative watch by S&P. Why? They did exactly what I'm saying India will do, which is they said their fiscal deficit will go from 3% to 5%. And Bank of Indonesia, the central bank in Indonesia, they said they will buy 25% of the issuances of the government. Effectively, they said they will print money. So that print and spend immediately had S&P putting them on negative rating watch. Indonesia is one notch higher than us. And we are at the absolute minimum investment grade. So if we go on negative watch, we risk our investment grade. We could become a junk bond. Now, it doesn't impact us in a big way, but it's still something to keep in mind, particularly since we need global savings to come in going forward. So very quickly, I'll come to the last bit, which is what do we do after we emerge out of COVID-19? I see one of two possibilities coming through here. One is there will be so much distress, and I cannot overemphasize this. There will be intense distress of a kind that we've not experienced before because it's a weak economy which is taking a battering. There will be a strong push towards populism, almost the 70s style populism. What does that mean? Garibi hatao. There will be a huge clamor from everybody, every sector, every community, every set of businesses saying, give me relief. I'm dying, give me relief. So that print and spend could continue well beyond the COVID-19 crisis as well. And you cannot sustain a print and spend unless you raise taxes, unless you put a wealth tax, unless you start taxing every income, and you start closing the economy so that currency does not leak outside, so that imports don't go up. This is back to the 70s kind of formula of populism, garibi hatao. That would be, in my personal view, I could be wrong, in my personal view, that would be a complete disaster. The positive view I have is, look, India reforms only when we are pushed to the wall. We do not reform when things are looking good. The moment we are pushed to a corner, when there is a gun on our head, suddenly the reform bug hits us. And we've got a good bunch of people who can manage that transition if required. I think that we will use this opportunity of being a completely battered economy to do all the right things that we have avoided for the last 5, 10, 15 years. And therefore, I'm hoping and praying that we see a 1991 style pivotal reforms which forces our economy to become a lot more conducive to creating jobs and creating output. That is the mantra. We have to create jobs, we have to create output, right? So what would that entail? There are lots of paths to creating jobs and output. To me, the following will work. One is we have to cleanse our banking system and our non-bank finance companies. This will require a lot of hard work. We probably need a bad bank to soak out all the bad assets. We need to undertake really hard reforms. There's something called the PJ Committee recommendations, May 2014. I think they're a brilliant set of recommendations. They can be used to cleanse the banking system. We'll require governance reform, credit rating agencies, auditors, board of directors, risk managers, all of that has to be cleansed. We'll also require market reform, secondary market. You saw yesterday Franklin Templeton closing down 6 schemes. Those kind of market reforms to ensure they don't happen. Again, those are required. One, full cleansing of the financial services ecosystem. That's the first part, because that engine is required to create credit and therefore create jobs and output. Second, all those sectors which I said are chronically stressed across your power, real estate, telecom, airline and shipping, we can't kick the can down the road on that any further. All these sectors, we have to get the stakeholders into one room, lock the door, throw the key away, don't break the door open until they've got a solution out. And by the way, solutions exist. Like the PJ Committee for banks, lots of committees have recommended good solutions for each of these sectors. Third, most critical, improving the ease of doing investments, ease of creating jobs for people like you. So if you want to start a company in India, if you want to start a manufacturing in India or a services in India which employs people, it should be easy for you to do so. If you're acquiring land, if you're acquiring capital, if you're acquiring labor, if you have to go through the hoops of getting policy changes, of getting contract enforcement, judicial processes, all that should be made easier. Again, you avoided the hard reforms on this: land, labor, capital reforms, and judicial reforms. That will be required. This list is a long, boily ocean list. And I have to admit, it's easy for a professor like me to say this. Extremely difficult to implement all this. It's a very, very big list. But we have no choice. If we have to create jobs and output, we have to go through these particular hoops. One last bit I'm genuinely hoping for as a result of the crisis, besides these reforms to create jobs and output. And why is jobs and output important? It's also important to pay for the sprint and spend. Because unless we create our output to pay for this demand which will come out of the sprint and spend, we will risk financial instability all over again. Inflation as well as currency crisis, just as we saw in 2013. So that's important. Plus, in the long run, we need jobs and output to take us to at least a middle income country, away from an emerging market status. We do need both of that to come through. Last bit I'm hoping for outside of all of this, look, we have, as an economy, as a country, we have completely underinvested in education, in healthcare, in nutrition. And for a country which says demographics is our biggest strength, it's criminal to have neglected these 3 sectors. I'm hoping one thing which will accrue from this entire COVID-19 experience is we pivot ourselves towards this healthcare, education, and nutrition. I think that's the best legacy we can leave to our children. I'm not saying giving them education, healthcare, and nutrition will give them jobs, because who the hell knows what jobs will look like in 5 years from now. Reality is every business is going to change going forward, and machine learning, the ways in which businesses contacts happen, everything is going to change. But if you give them these 3 things, you're at least equipping them better to handle with all the uncertainties of the future. Just as my generation handled the uncertainties of my generation, the next generation requires skills to be able to handle that uncertainty as well. In summary, look, the economy was weak to start with. It will take a battering through COVID-19. It's going to be an extremely large battering. I cannot overstate this. We will come out at policy crossroads, either shift towards populism and in my view, disastrous populism of the 70s, or I'm much more hopeful towards a pivot towards much needed reforms, which creates jobs and output, and hopefully gives a lot more towards healthcare, education, and nutrition for our children. I've exceeded my time, so apologies for that. Very happy to take questions now. Yeah.
Thank you so much, sir. This was really insightful. We often see you on different news channels as part of various panels. It was really glad to have you on our own SPJIMR Alumni webinar. So let me ask you, there are a lot of questions we've got today, more than 30 to 45 questions. And given that we have limited time, I think I'll generalize few of the questions and put it across to you. I'll try to avoid the questions which is already covered by you. So the largest question today is our dream of becoming a $5 trillion economy. Is that still attainable? And what do you think would be the new timeline like?
Thanks, Siddharth. And by the way, thanks for doing this. Really appreciate this, Siddharth. And we should catch up sometime later. Look, I wouldn't worry too much about targets like $5 trillion over the next few years. Those are targets which are, big, hairy, achievable targets or whatever, to keep you focused. I wouldn't go rigid on them. The broad point is effectively how do we pivot towards creating jobs and output. And I hope if there's one thing that comes out from this talk as a takeaway, it should be that. How do we pivot towards that? Here is the beauty. I have worked in 12 countries, okay, including in emerging markets like Vietnam, in Bangladesh, in Philippines, in Thailand, etc. Right? All of them are young countries. All of them have a lot of energy. They all have fire in the belly. But I have not seen any country with the combination of skills, with the combination of aspiration, with the combination of potential, as you see in India. So is it within our reach to become a middle-income country? Can we make the next 2 decades our decades? Absolutely. Just as China's, made the last 3 decades their decades. Do you know, for instance, Siddharth, that the per capita income in China was actually lower than the per capita income of India in 1990? People say 70s, that's wrong. Even in 1990, their per capita income was lower than ours. And in 30 years, they've transformed. The next 30 years can absolutely be ours. But what we need is jobs and output. I've given you one, pathway to that. There could be other pathways as well because the world is changing, economics is changing, but that has to be our focus. How do we get jobs and output? If we get that, 5 trillion will happen. Even 10 trillion will happen. Might not happen by 2024, but eventually will happen. We will become at least a middle-income country.
So just an add-on to it, a lot of countries have some anger against China. A lot of whisper about India replacing China in the global value chain. What steps should government take in this regard? Is it possible to actually replace and overshoot China in this entire global value chain?
That's a brilliant question, Siddharth. Thanks for asking that. Yeah. So look, when I gave a very dreary analysis and I said things are looking bad, I should emphasize there are also a lot of tailwinds in our favor. Okay. So one, as you mentioned, even before COVID-19, because of this US-China trade war, people were moving their supply chains out of China, right? Now, after COVID-19, that animosity has become even greater. And it's much more than just an economic animosity. It's far bigger than that, which means there will be supply chains moving out of China. Mind you, that doesn't mean things come automatically to other countries. There's also this whole localization, which could happen right now, which is things go back to the home countries with automation rather than using labor, etc. But there's clearly this positive of businesses moving out of China, which means we could stand to benefit. There are other positives, oil prices being very low, energy prices being very low, renewable energy is picking up. That's a big positive for a country which is starved of energy like India. Again, that's a big positive. Third, global interest rates and inflation are going to remain low for a long, long time, which means getting in global capital should not be a problem for us if we put up the right credentials. But the reason I don't emphasize this is the following. We cannot have a strategy for growth based on other people's weaknesses or based on tailwinds taking us over the finishing line. That is a silly strategy. And because we were being very cock-a-hoop about those tailwinds and about businesses moving out of China, we actually are missing the bus in terms of getting those supply chains. Instead, we were losing them to Vietnam, to Korea, to Taiwan, to other countries, right? And the point I made to you about us needing to make investments easier in India, and that requires real reform, right? Which means along with these tailwinds, if you don't accompany that with, let me make it easier for you to come here and set up a business, buy land, get people, labor on board, get capital, manage with all the bureaucrats, etc. That ease of doing investments has to be put in place. So all the tailwinds, including the fact that people want to move out of China, will come to naught if we don't create the conditions for making it easier to invest in country.
Sure. So we have a question from Kapil. What sectors do you think will be most impacted by this pandemic, and which are the sectors you think will be least impacted by the whole scenario?
Siddharth, that's I think it's easy to guess. So sectors such as airline and shipping, for instance, are clearly going to be impacted in a big way. Likewise, hospitality, tourism, entertainment, anything which calls for social meeting and going out, etc., is going to be a problem. Even things like restaurants, etc., are going to be a problem because again, even if the lockdown is lifted, you might have people reticent about going out and having a good time for a long time. So anything which is non-essential, anything which involves social interactions, anything which involves people traveling out and spending, etc., discretionary spending, that's going to be a problem. On the flip side, anything which is essential, so your pharma, your medical services, your health services, your food-related services, all of them obviously will be critical and will probably do well. So all your essential services and provisions, etc., will probably do well. But that's very simplistic. I'm sure there are opportunities for every business to repivot themselves, to rethink about how life will be after 2-3 years, which is why you should probably go through a design thinking course with Dr. Banerjee or with other professors at our institute. There will be opportunities and there will be threats for every single business domain. The question will be, how do you navigate through that, okay, going forward at least.
Right. Another interesting question. So we see a lot of, the way consumer will consume different services and products will evolve and will change for sure. So what do you think, what should be the strategy of any company or, young managers in order to transverse this part? What will be the impact on demand side and supply side of the things?
Right. So look, I'm not going to answer directly, but I'm going to answer indirectly. So look, in India at least, we tend to consume when we see investments around us. It's a kind of a paradox here. For instance, today, if every Indian is given 3,000 rupees by the government, saying, you know what, essential services, le lo, paisa le lo, and survive, I can tell you spending will not go up. People will save that money, only use it for essential services, right? You will not spend it off on something immediately, right? When will you start spending? You will start spending when you see growth around you, when you see your company doing well, when you see your stakeholders doing well, when you see jobs in the market. That time you feel like saving less and spending more because money is going to come to you. So getting the spending up, especially the discretionary spending, is going to be a big function of the sentiment. By the way, I didn't talk about global markets at all, but it's a bigger problem for developed markets where your discretionary spending is a much bigger basket of your consumption basket, right? In India, even now, 46% of your consumption basket as per CPI is actually food, which is essential services. So discretionary spending is quite low. In the US, your food basket will be just 2 or 3% of the entire consumption basket. A lot of it is discretionary. So getting that sentiment positive again for people to spend again will be critical. I'll add one quick point, Siddharth. I talked about getting in supply chains from China and getting in jobs and output as a great way to pivot the focus. If for India specifically, at least what I'm telling my friends in Delhi and in other places is pivot towards area where consumption is domestic. Because see, the world could change going forward with all this talk against globalization. Relying on exports might not be the smartest of idea at this point in time, even though we have technically a lot of advantages of being able to export. So I would start with make for India rather than make in India. What does that mean? We have 1.35 billion people who will consume electronics, who will consume proteins, as I mentioned earlier. They will consume plastics, they will consume cement for building houses, as and when things get better. Make sure that at least those items where we have a captive domestic consumption market, At least those items let's focus on. Get the Foxconn of the world to produce the Apple phone in toto here, not just assemble, but actually the entire supply chain, get them to input here. So in terms of businesses, I would focus on domestic demand. In terms of the overall sentiment for discretionary goods, unfortunately, that is a function of the overall sentiment, which is what the governments and central banks around the world are trying to address.
So the next question, a lot of people have actually asked about a certain topic, Yogin, Ankit, Mohit, Rachit. So there's very limited scope for fiscal and monetary, stimulus, given that, there's already probability of bonds being degraded to junk rate. So what do you think what will be the most logical step, next step for the government in terms of coming up with the fiscal and monetary stimulus? And do you think India can go the US way of, doing significant borrowings, as long as the debt to GDP ratio is under control in the long term?
So again, great question here. And frankly, that's a critical policy question, which I think even Delhi is grappling with today on how much can you really spend. So the fact that you've not got a second fiscal package, I think is because they're worried about how much fiscal room they actually have. So here is my prognosis, Siddharth. As I mentioned in my talk, I don't think we have a choice. I mean, we are going to bust the fisc. By the way, the people refer to me as a fiscal hawk, as somebody who says don't bust the fisc. I am telling you, we have no choice but to bust the fisc. Why is that? I mentioned to you our tax collections are going to plummet. We will not have tax collections. So how the hell do you manage your fiscal deficit if there is no tax collections? Second, for critical to stave off a humanitarian and economic disaster, you have to undertake critical spend. This is a time of war. At a time of war, you don't scrounge and say, you know what, I'm going to save money here and there. No, you have to spend. You don't have a choice. The point is, every penny that you spend, you have to be painfully aware that you'll have to pay for it with interest later. It's going to become a burden for you to actually pay for later. And that's the reality. All the print and spend will not show up today as a problem because the whole world is printing and spending, because there is no domestic demand right now. We're all under lockdown. We're not consuming anything. So there is no demand-led inflation at all. We are not importing anything. There is no oil imports happening right now. I mean, oil prices are very low, but we can't import it. We're not importing it. So with no consumption, with no imports, with the whole world printing and spending, there'll be no problem now. But that will be a false sense of security that we might draw. 6 months later, 9 months later, every single penny that we inevitably have to print and spend today, we'll have to pay for. So we have to be aware that we have to choose the amount of money as only the critical amount that we have to spend. And the only way to spend for it, in my view, is you have to increase jobs and increase output. That's the only thing which will pay for your print and spend. Otherwise, you risk inflation, you risk a currency crisis, you risk financial instability.
Right. So interestingly, whichever, most of us are attending webinars, and, most of the webinars we hear two words which are very common these days: unprecedented and unheard. I think one of the interesting unprecedented such event was crude prices, the future prices going below zero, negative. So what do you see the impact of crude prices on Indian economy going forward?
So Siddharth, very quickly, I wouldn't read too much into the current crude prices as an extrapolation to what happens in the future. These are funny times where global demand for energy has collapsed because a lot of the countries in the world are completely under lockdown. We are not consuming energy anymore, right? So if your global demand from 100 million barrels per day has come down to 70 million barrels per day, clearly you're going to see a collapse in prices. And that's the reality, right, to start with. The second problem is, the May futures of WTI, Western Texas Intermediate, going into negative was a very crazy quirk where people, ran out of space to store the bloody oil. So because there was no way of evacuating the oil and storing it, even the carriers are completely full. That's why it went into a negative territory. But 6 months later, when the global economy limps back to hopefully something like a normalcy, that's when you have to determine what happens to crude oil prices. I have to warn you guys, because of this, crude oil prices being where they are, a lot of the shale industry people are going to get massacred. One of the reasons why crude oil prices came down in the last 10 years is because shale oil went up, right? If shale oil capacity comes down dramatically, because a lot of them are highly indebted, they can't pay back the debts, they're bankrupt right now. And if that Permian Basin stops producing shale oil, you could have a funny situation of oil prices going up 6 months from now in a much bigger way, because that supply simply goes away, it dies, right? So we don't know how oil prices are going to work. as I said earlier, while we can count our tailwinds as a bonus, the tailwinds of low oil prices, people hating China, cannot be the cornerstone of our strategy. The strategy has to be jobs and output. If we get conditions which are conducive to that, that's great. And by the way, oil prices at $10 a barrel is bad news for India, because it normally means the global economy is in a complete funk. It also means that our remittances coming from the Gulf, etc., come collapsing down. It also means that there is no global growth going through, which means you don't get global capital. Funnily, even though we import 1.2 billion barrels of oil every year, for us, $30 to $40 is far better than $10 per barrel, in a very funny kind of vicarious way. Last bit I'll add, look, while this is about the next 6 months, 1 year, etc., the broad point about solar energy and renewables and wind energy being a good alternative source of energy and an economical one is actually a huge tailwind for us as a completely energy deficient country. As long as that engine fires, it's great for us. I hope that trend continues. That should make it much more easier for us to convert this into jobs and output, like I've always been saying.
So we have over 20 questions, but given that our time is almost coming to an end, one last question, and this is a question which most of us are maybe worried about. Given that most of us invest in equities and most of us would have our portfolios in negative, what do you think the investment strategy for all the individuals should be, in what different asset classes? Because we've seen what has happened to the debt market. A lot of individuals have also invested in Franklin Templeton kind of debt liquid assets, and now they're all of a sudden illiquid. Equity is down. Goals have risen to an level which has not been earlier seen. So what do you think should be the investment strategy for most of us as individuals?
So Dr. Pallavi Modi and I take this course on investment finance. So look, I won't give you specific recommendations and tips. I'm bad at recommendations and tips, individual ones. In fact, if you want tips, listen to me carefully and do the opposite, you'll make lots of money. But very broadly, look, what matters is having an asset allocation done here. The first thing you learn in investment finance is it's not the individual stock you buy, it's not the individual security you buy, it's not the timing of your entry and exit. It's the having an asset allocation which is sensible for your risk profile, right? And that asset allocation, by the way, does not change in a big way just because markets have moved. So a good asset allocation will have debt, will have gold, will have equities, will have real estate, will have foreign currency, will have commodities, will have a multiple set of asset classes built together. That's the way you hedge yourself and your savings against future inflation, and you kind of prepare for the future. That asset allocation should not change. If you've got a very skewed asset allocation, I would strongly recommend, I have a wealth advisor. Even though I'm supposed to be a markets guy, when it comes to personal money, I prefer to pay for my advice and getting an asset allocation advice done by a professional person. I think it makes sense to go through that in a professional way. At times like this, frankly, if you have your asset allocation right, you should be changing nothing. You will see losses, but there's no way you can avoid losses because debt is losing money, equity is losing money, commodities are losing money, lots of things are losing money. Only gold is probably holding up. So you will lose money, but if you're diversified well enough, you'll be minimizing your losses and you'll be minimizing the volatility of your portfolio. By the way, on timing, I don't know how we are on the webinar. I have time, so I can take more questions depending on the participant interested.
Sure. That is great, actually. So we have quite a few more questions. So maybe I'll try to share another couple of questions. So there's a question from Ram Narayan that should government focus more on SME and MSME based stimulus rather than a more generic and a social stimulus? Will that work? Because more and more people will get employment, and that could be a direct impact on the economy.
That's a brilliant question, Ram Narayan. In fact, if you look at what the US is doing, it's trying to kill two birds with one stone. It's offering a lot of funding to small businesses. In fact, it's offering loans, very, very low interest rate loans, and those loans will be set aside. They'll be forgiven as long as the proceeds are used to pay salaries to the workers, which means as long as you're not sacking people and you're paying the salaries which are due to them, right? So it's a way of supporting businesses and ensuring that money goes towards payrolls, right? That's a beautiful actual ecosystem to try and protect the entire society. Unfortunately, that'd be very tough in the case of India. So I don't envy the government's shoes at all. The point is, 85% of our businesses are in the unorganized sector. How do you define unorganized sector? People, less than 10 people employed in a particular firm. So a startling 85% of our entire workforce is in the unorganized sector. It's very difficult to reach out to all of them going through the individual companies involved. If they're all mom and pop shops or very, very small entities which don't really have a banking ecosystem to support them, it's very difficult to reach them through the formal channels, which is why probably we need a combination of the two. Look, who are the people who are most vulnerable right now to this COVID-19 humanitarian disaster? It's going to be the people who are in the bottom of the food chain, right? The lower part of the pyramid, who are daily wage workers, who are construction workers, because there's no construction happening. After demonetization, you had daily wage workers lining up in the Gurudwara langars for food because there was no daily wage, there was no money. I'm sure something similar is happening now. People are like fighting for their daily necessities. You have no choice but to try and give money to everybody there, right? You have to give something like a universal basic income where you say, okay, here is 2,000 rupees, take it. Just so that you can buy whatever is required, you don't starve, right? Here is some good news, Siddharth, on that and Ram Narayan on that. Actually, we have a PDS system which at least works in theory. So every individual, every human being above 5 years of age is supposed to get 5 kgs of rice and other grains through the ration system. It's being delivered. Our food stocks are more than plenty. Yes, you hear of cases of people who don't have ration cards, who don't have below poverty line cards and so on and so forth. But even that, I'm sure state governments are taking care of. So at least food and basic essentials, there is an ecosystem to make sure that gets delivered to the people, right? On top of it, they will have to spray money to the individual people. But the point that Ram Narayan made is important. Small businesses will need help. By the way, I didn't mention this. Unemployment in the US already is about 13-14%. Now, we don't measure unemployment, unfortunately, in India in that high frequency. Chances are unemployment has already crossed 20% in India. Okay, this is a complete surmise, but based on the discussions I've had, I think it's higher than 20%, probably even higher than that now. Okay, now that's going to impact. That's a reflection of the pain that businesses are going through as well. A lot of small businesses will not survive COVID-19. So unfortunately, the government will have to do both: give money through universal basic income, as well as give money to small businesses. One, by the way, idea which the government is toying with is give a guarantee for loans to small businesses to the extent they've paid taxes the previous year. So in a way, because you've received taxes from them, you know these guys exist, you know these guys pay you taxes. So, okay, fine, you know what, until that extent, let banks give them and I'll take the loss on that as the government. Unfortunately, the government has to step in. It goes back to the point you asked, Siddharth, which is that we'll have to print and spend, which is a sad situation. And we have to do it for humanitarian and economic reasons. We also have to be painfully aware. Every penny we spend now, we have to pay with interest in the future. It's not a free lunch, unlike the case of the West.
So most of us would have maybe, gone through a couple of such cycles of crisis and showed up multiple of those, and maybe from inner being, insider to the industry. What would you say are your, top 3 learnings from such crises, and what do you suggest to be, better prepared for such crises as an individual or as in corporate? How should you preempt and, be prepared for such crises?
So I'll think through the top of my head here. So look, listen, first of all, this you mentioned that the misuse of the word unprecedented, etc. Unfortunately, that word could well be, justified in this case. If we go down that 1918 Spanish flu experience, which is what the Imperial College studies are right now predicting or projecting, this will be once in 2 generations kind of an experience. So none of us have gone through this. You're as clueless as I am as far as this experience is concerned. I hope it doesn't go that far, but we have to be prepared for the eventuality. Few things that we have to keep in mind. One is, look, the world is changing rapidly. And I think COVID-19 just underscores that fact. Even before COVID-19, we knew our businesses were changing, right? We knew technology, we knew the way of contacting people, the way machine learning, artificial intelligence, automation. We knew all, and social media, smartphones, all of that was changing the way in which we do businesses. My own business, banking, is going to look, is already very different than it was 10 years ago. It's going to be unrecognizable in 10 years from now. You know, with Google Pay, with all kind of wallets being available, with all kinds of other technology firms getting into banking and into money creation, it's going to change completely. I think COVID-19 underscores the fact that change is hitting us really hard. Every single business, like I said, is going to see a lot of transformation through this COVID-19 experience. So being nimble and thinking about the future, something you've learned in SPJIMR as part of the MBA program, etc., has to be the critical part of your survival, which is you have to think 2 steps ahead of what could happen to your business. You know, there's this huge story about telecom companies getting eaten up by WhatsApp. 10 years ago, 15 years ago, SMSs was the biggest source of revenue for telecom companies. That got killed the moment WhatsApp came in and voice over internet protocol came in, right? So likewise, every single business is going to get transformed. You have to try and stay ahead of the pack. Second part, risk management. You can't, the point you made about equity market losses, etc. You can't put all your eggs into one basket. You have to have a diversified basket of both in your investments as well as in your savings as well as in your businesses. You can't be a one-trick pony. And there'll be a lot of people who will compel you to saying, this is the idea, just put all your money into it, leverage, borrow money and put some more money into it. Never. Be extremely careful about doing that. The need to have a diversified portfolio when things are going out of syllabus so quickly, I think is extremely important. Third one, if there is one thing that COVID-19 teaches us, it's the value of family. While I'm hollering here in my room, I can hear my mother chanting her shlokas. It's that time of the evening for her. The value of being close to family, the value of connecting with where you come from. If there's one positive out of the whole COVID-19 experience, I guess it's that. Yeah.
Perfect, sir. Thank you so much. We often see you, as I said, on most of the news channels. And to have you on our own SPJIMR webinar, it was really glad to have you. Thank you so much, all the attendees. I understand there were quite a few questions we could not individually take as, either they were covered or given that.
Can I just add?
Yes, sir.
So you're aware that we have CFS, the Center for Financial Studies, which has been set up in the last year in SPJIMR. It's run by Neeraj Swaroop, who's, by the way, my former boss in State Standard Chartered Bank, a fantastic guy. I don't know if you met him. It's a good team. It's got a lot of people who are industry experts. It's got all the professors who you know very well in SPJIMR. It's a hungry team which is trying to do a lot of things, including into fintech, into policy studies, into making education available for connecting the industry and influencing practice, which is part of our motto anyway. So we're trying to do all of that. Couple of requests. If there are unanswered questions, again, I apologize for overshooting my time. Do try and send those questions over to us at the CFS, maybe through Siddharth, maybe through Ratika. We'd be very happy to try and address them offline and connect with you offline. Second request, as and when COVID-19 is behind us, and I hope that happens fast, please do come and visit us at CFS, meet up with Neeraj, meet up with the team, and try and see in what way we can help you from CFS. It's a good initiative. We'd love to see CFS become, connect the industry and the academia and research and policy makers in a big way. Do help us in the journey, and we'll try and help you as well.
Thank you so much, sir. Yeah, as so requested, please go through your mails, which often come from the alumni committee of the college. Do take part in most of the CFS and other activities. As you would know, we have another similar session happening next Saturday, similar time, taken by Dr. Ranjan Banerjee. Request everyone to kindly register for the same and attend the same. And do write down all the questions that would be unanswered. We'll definitely try to answer them. Thank you so much. Here is Siddharth, Parakh signing off for today. Thank you.